The market does not like things that are unknown. So, we have, the trade and tariff wars that are going on here. What's going to come out on the other side of it? What's the impact that's going to have on earnings? So again, a lot of uncertainty and unknown.
Well, how do you construct the game plan for retirement and deal with loss of yardage or even turnovers? We'll talk about it today on Your Game Plan for Retirement with Chris McIntire as we continue to deal with market volatility. How do we continue to make the forward progress, keep the right frame of mind that we are still winning the game? Well, Chris McIntire talks to us about that each and every week here on the program, and we always appreciate the perspective. Chris, thank you for being here, and I'm sure that you are fielding questions, hearing from people who are concerned about this market volatility and what that is doing to their forward progress.
Yeah, without a doubt, I think there's not an advisor in the United States that hasn't gotten some communications from nervous clients. And, there's a lot of emotion, right? And, you start watching these news programs with the Dow down 500 to 1,000 points, that's an emotional trigger. And, especially if you're just coming into retirement, if you're, 9, 10 years into it, it's probably not nearly as emotional because you've gone through a few things as well, and you've been in that distribution phase of money for some time. But if you're used to putting money into your 401ks and in 6 months that money's got to be coming out of the 401ks, the last thing you want to see is a 10-15% correction, and even worse than that, obviously. And that's very understandable.
Well, I know that you construct plans to deal with market volatility and try to keep your clients not only psychologically well prepared, but financially well prepared ahead of time for the reality that the markets move up and down at times, and that you have the structure within the game plan for retirement to understand this and can continue to move forward with a firm foundation. And ladies and gentlemen, if you would like to get together your personalized game plan for retirement with long-term and diversified strategies, or if you would like to review and evaluate your current plan, your accounts, your investments, those retirement dollars, and what each and every one of them is doing for you, pick up the phone and give McIntire Retirement Services a call, 419-332-0532, 419-332-0532. And sometimes, Chris, loss of downs or loss of yardage, I know football analogies here, but it is game plan for retirement. Those can feel self-inflicted and kind of defeating, but we can regroup and continue to make forward progress. It's not like the game is over when we see a little bit of market volatility here, to round out the analogy.
Exactly. If you're still working, you're putting money in and making your contributions. You don't want to stop doing that, because when the market goes down, you buy more shares of stocks and bonds if they're down in value. So these are great buying opportunities. And, it's easy to say, well, I'm going to put my head in the sand and bury myself in cash right now and wait this volatility out. And, I've got a piece of paper right here, showing that, if you miss the top 5 days in the stock market, over a 20-year time frame, for example, just the top 5 days, which typically happen after the worst 5 days, you're going to cut your returns, almost by 30-40%. Those are proven numbers. And, with people that are retired, they should be, investing around their risk tolerance anyway. So, that should help soften the blow, because not everybody's got 100% of their money in the companies inside the S&P 500. They may have, some money market funds. They may have CDs or the annuity side of things where it's safe. And then a balanced portfolio of stocks and bonds. And, I suppose we could even say gold, just to diversify. It's times like these where that solidify the reasons you lay a nice solid foundation for your retirement plan.
Yeah, and you've been talking about this for years, Chris, the reality that the market does not always move up, that we do have volatile times. And of course, 2022, as interest rates were climbing and markets were falling, we talked a lot about the reality of market volatility. And here we are again in 2025, different impetus, but same net result, is that we are seeing shaky markets. And I know that your clients with the game plan for retirement are properly aligned for these things ahead of time, but still that market uncertainty, while volatility is to be expected, can induce some panic. And your comment about the best days in the market often happen right after some of the worst days. What we don't want to do is react emotionally, see the market fall. Maybe it does test our comfort level, but then sell out and miss those bounces back, those some of those best days.
Yes, I mean, just recently, the Trump administration came out and said, "Hey, we're going to do a 90-day pause in implementing most of these tariffs." And the stock market had one of its best days in history. I think the S&P 500 was up almost 9% that day, Well, you don't want to be in cash and miss a 9% day. And, it doesn't mean it's not going to test its low again. Obviously nobody knows. That's why you have to stay in the market. So if you're not in it, you cannot win it. And again, balanced around your true risk profile. And I think last summer you and I were talking, about the real risk tolerance that people have. And now you're finding out what that really is. It's one thing when the market's going up 15, 20%, you're probably not looking at somebody's real risk tolerance. It's when it's going down 15 to 20% when you really find out what human nature tells you about somebody's overall risk tolerance.
Where the rubber meets the road is on on the way down. And there's another analogy, Chris, that most people who uh, pass away climbing Mount Everest don't have those accidents, don't die on the way up. They're more likely on the way down. And whether it's decumulation and trying to unravel the portfolio that you have built over your working career and then have that income and distribution plan, or as the markets fall, I think that analogy holds true. So we want to talk about market volatility today, how to have a plan in place that allows you to have confidence and reassurance that you do have a firm foundation and can still make forward progress. And of course, that is all revolving around having a plan, not just accounts, not just the 401k, the IRA, or the brokerage account, but a plan that brings all of those pieces together. When and how will you use those? What will they do for you? What will the tax implications be? What kind of growth rate do you need on them? How all of those factors come together to form your picture for your goals into your financial future. It is a personalized process and plan. It is your game plan for retirement. And if you'd like to get that put together, pick up the phone, give a call, 419-332-0532, 419-332-0532. So while the reasons, the motivations, the catalysts, Chris, may be different from time to time, the reality is markets do see volatility periodically. What are some of the reasons that you are seeing for this round of market volatility and what we're seeing in the markets right now?
Well, I believe, tariffs, the threat of tariffs obviously would be one of the biggest pieces there. The unknown circumstances. So the market does not like things that are unknown. So, we have, the trade and tariff wars that are going on here. What's going to come out on the other side of it? What's the impact that's going to have on earnings? So again, a lot of uncertainty and unknown. And if you're uh, a CEO of a major multinational corporation, how do you forecast?
Mhm.
How do you go about hiring? How do you go about, adding on building a new factory when you're not sure what's going to come out on the other side? So I think, every leader around the world wants to get these tariff pieces behind us and renegotiate some of the, and I'm going to use the word unfair trade practices that they have been inflicting on the United States. And, some of these things are, inflicted by our elected officials, obviously. We have geopolitical risk as well, right? You have, Russia has invaded Ukraine. That upset the oil markets. That upset some of the grain markets because Ukraine is a huge exporter of wheat. I mean, they basically feed the breadbasket of
The rest of
Europe.
Europe. Yep.
Yep. And then the transportation over the Black Sea, through some of those areas where there's conflict going on. Obviously, you have Israel and fighting with Hamas, fighting with Hezbollah. You had Syria in civil war. Their leadership has changed there, and you got a former Al Qaeda operative running that. So that that Middle East there, the Houthi rebels, obviously, right? the flow of cargo ships through the Red Sea and up through the Suez Canal has significantly been impacted there by those Houthis. So, and that adds to shipping cost, right? So, and who does that pass on to? That passes on to the end user. So some of those things are inflationary threats. What will happen to the markets if China was in fact to take some sort of action of aggression toward Taiwan? That would, where 95% of the computer chips are made. So that's a geopolitical risk there. The legislative side is, we're spending $2 trillion more to keep digging this debt hole deeper, and we're seeing that right now in a lot of the headlines that the U.S. may not be the safe haven that we once were. As people look at this, our fiscal irresponsibility. So if there is some sort of bright side in the middle of all this chaos, is maybe we do start some fiscal responsibility here with our debt and whatnot, and curtail the spending on the federal government side. Because our economy in the United States is 75% consumers spending money, 25% government spending money. And I bet if you went back and had the time and do the research since COVID hit, okay, there was a lot more government spending with stimulus and whatnot than there was consumer spending, kind of indirectly. So, as this economy, you look at the chart on the Dow Jones Industrial Average since about April of 2020, just how fast it went up. Well, that was government fueled spending. That wasn't necessarily, people working and, productivity gains. And now with artificial intelligence and things that are coming around, the infrastructure is being built for artificial intelligence, the productivity is going to come behind that then. And that would increase profitability for companies and, evolve new opportunities and whatnot, not only for employees, but investors and whatnot. So a lot of bright spots down the road. We hope this is a short-term piece here in the tariff side of things, and they get things negotiated and things get back on track. But, uncertainty drives volatility. That's probably a good summary of a long-winded statement by me.
You mentioned the fact that the markets hate uncertainty, and it leads to more volatility. Is that why, Chris, historically, when there is mixed leadership and no one party can push broad, sweeping agenda changes impactfully, like unobstructed, why generally, when there is mixed leadership, the market fares better or at least more stably?
Yeah, without question, because you know that you're not going to get real significant changes, right? There'll be some sort of negotiations and, talk about taxes, for example. This would be a good thing. The Republicans have all three houses right now, and it looks like they're going to try to pass and make the Trump tax cuts from his first administration permanent. Okay. Well, if they do that, then there's no threat that our taxes are going to go up. We have more dollars in our pocket. Okay? If we get more domestic oil and whatnot producing here in the United States, right? The more oil there is, the more competitive it gets, prices come down. That's like a tax cut. If we get interest rates that cut, okay? If you have mortgages, you can refinance, or if you're looking to, change your homes, and if you can do that in with a substantially lower interest rate than what we had, they went down by 1% already, and I know that's kind of been a headline piece here that the President Trump would like Jerome Powell to cut those interest rates quicker, and I would certainly think that would be good as well because the European Union has cut 7 times this year.
Hmm.
The United States, we've cut 4, and we're kind of playing this wait and see thing on the inflation side. So, a little tit for tat going on there in the powers that
I
be.
feel like that would stimulate the housing market, which is kind of a ripple effect on the broader economy, certainly.
Yeah, without a doubt, Peter. And, there's a lot of first-time home buyers that are sitting on the sidelines waiting for interest rates to come down. There are first-time homeowners that want to take that next step and move into the next neighborhood, so to speak, as many of us do in our adult lives.
I actually I speak with a mortgage broker on a fairly regular basis, and he was sharing with me last week that just in my county alone, there are 110 units, rental units, households that are currently renting that could technically qualify for home ownership who are still renting. And he said that a large part of that is attributed to just the let's wait and see if these interest rates improve.
Yes, and so, and Peter, kind of back to your, one party running all things, like the Republicans have all three houses of government right now. In Trump's first term, the Democrats ended up getting control of the House, and I even believe the Senate was been so close I can't remember as we're recording the show, but it's been going back and forth. It happened under Obama. Republicans got control of the House. It happened under Joe Biden. The Republicans got control of the House. So it's not uncommon for, the powers to flip. And the market does like a divided Congress because you don't get this radical changes. And, if you had, a super majority in the Senate where you could, get a 60 vote margin, you might see a lot more things, happen
Yeah.
quicker, because they could turn the tide and you don't have to worry about, if you get that 2/3 majority to pass those major legislative pieces. But I think the tax cut piece is certainly going to be, I'm very much in favor of extending those tax cuts because the 12% tax bracket would become the 15% bracket once again. That's a 3% increase on about $70,000 that is in that tax bracket. So that's a $2,100 tax increase for Main Street America.
If I'm bumping from paying 12% to paying 15, it's 3% higher, but that's 25% higher bill. Like the
Yeah.
the dollar cost on that is a 25% increase in the price that I would pay for taxes on that bracket of income, and that's pretty substantial. Chris, I know, and as you mentioned, like it's not just change. It's like the potential threat of change. And the market is very finicky and fickle and reactive there. And it always seems to trickle down to individuals and small businesses, and costs or uncertainty passes down to the little guy. And even with the tariffs here, you mentioned shipping and large corporations not developing, but like the small businesses that are relying on goods maybe manufactured or produced in China. I know there's a lot of doubt and worry and uncertainty there as well. I heard somebody recently mention, well, God made the world, but everything else is made in China. And it seemed apropos for the amount of reaction we're seeing in the market due to largely just the stalemate of China and the hardball negotiations that are likely to come there.
Sure, and I think it's a test of will who's going to blink first, and they are softening that rhetoric right now, China and even the current and even President Trump, to try to get to the negotiating table here and start doing something that's fair. And I think China certainly has some economic weakness going into these trade wars, right? Their real estate market and a number of things that they had over there were in very dire straits. And, the government can only fuel things for so long, as we see, until you rack up, an insurmountable amount of debt. So hopefully, the U.S. addresses our debt and, maybe China, addresses some of their issues and we get some more fair trade practices between the two. I'm not so concerned we're going to make the little, aren't plastic army guys here in the United States. Those probably aren't the biggest paying jobs. But, when you start talking about computer chips, pharmaceuticals, getting some of the precious metals, I mean, we have all that stuff right here. It's just nobody wants it in their own backyard. So
Mhm.
at some point, we have to find out what we can and can't live without.
Well, again, we are talking with Chris McIntire, president and founder of McIntire Retirement Services, talking about some of the forces and factors that have been impacting the market, why we are seeing volatility, what has been the catalyst for this. But of course, if you want to make sure that you are making forward progress to your personal important financial goals like retirement and wealth preservation and passing assets on or minimizing taxes, you need a game plan for retirement. That is exactly what they put together there at McIntire Retirement Services. All you need to do to get that conversation started, pick up the phone, give them a call, 419-332-0532, 419-332-0532, 419-332-0532. Now, Chris, 10 questions. Investors are asking 10 questions Especially nearing retirement, investors are likely asking either themselves or their advisor, number one, am I taking too much risk in my current investment portfolio? Are we hearing this? Is that a question? How do we gauge if we are taking too much risk?
Yeah, and that's a tricky question right there for sure. So, if the market's here, if you're looking at your statements and your accounts every single day, I'm not sure how healthy that is. I don't look at my investments every single day, especially when we've had a real bad day, right? Because
Yeah.
it doesn't help, you know. I look at them kind of on a more measured basis. I make better decisions when we do that. And certainly know the long-term plan, what I'm looking for. That's why I buy stocks. I want it for the long haul, not for tomorrow. That's why I
Number
have money in, yeah, that's why I have money in a money market account. That's what I might need tomorrow. So, and then, if we've got some bonds in the portfolio or, some other diversifiers, an annuity in there just in case the market goes down, you can turn your annuity on for income or just simply make a withdrawal from it, So trying to gauge somebody's risk because nobody wants it right now. Everybody's got a high degree of risk tolerance right now, but this thing can turn pretty quickly on the announcement of a couple of major trade deals with the partners. And again, some of these things take time, right? We live in a world of instant gratification. Man, you're talking trade agreements that may have taken a year of negotiations to put into play. And obviously, the Trump administration comes at it with a business approach, not a bureaucratic train wreck that we've had before. And forgive me, but I'm just being honest, right? Bureaucrats should not be running the government. Businessmen should also be in there with some, helping make some decisions there, right? To cut through the crap. Nothing against Alexandria Ocasio-Cortez or AOC, but tell me what corporation she's run, but yet she's dictating all the regulations that these corporations need to run by.
Number two, how would a market downturn right before retirement affect my income? This is a big one that those in the red zone need to consider.
Yeah, buddy. And, especially somebody who was a heavy stock investor. And so let's say, their $1 million portfolio, to use an even number, fell by 20% because they were heavy in Nvidia and Tesla stock, that type of thing, the tech sector that made them a millionaire. Okay? And now that $1 million portfolio is 800,000, So if you were going to take 4% out of your portfolio, $1 million is $40,000. At 800,000, it's 32,000.
So number three, Chris, should we adjust our asset allocation as we near retirement?
Yeah, and make sure that's aligned with your true risk tolerance there. Do you need to, add more money to the bond side of things to help cushion the blow? Because remember, when you're drawing money out of your account, it's those significant drops that hurt the most, not necessarily the ones that are a little bit more of a gentle slope.
Do we need to take steps to protect against sequence risk?
Yeah, without a doubt, and that's why we hedge and use, fixed index annuities, fixed annuities, CDs, money markets, to hedge against that sequence of returns risk where your first year in retirement, the market's negative 20, that you have an alternative to draw your assets from and give your investment portfolio time to recover. Good question, Peter.
Number five, how do I know if I've captured enough gain and growth to start shifting toward that income focused investment portfolio?
Yeah, and it's based off what's the balance of your investment portfolio. Again, did you go the year before you retired? Did you go from 800,000 to $1 million? It's like, all right, now you take that, some of those gains or a significant portion of them and put them into something that can help create and generate income like dividends and interest and structured notes that we use in our practice as well. Yep, that offers some downside protection also.
I think we addressed number six during the first half of the program, and I know we're just fresh into a presidential term here, but how far forward do you look, Chris? I'm going to rephrase this. The number six question, how do upcoming elections impact retirement plans? How far forward do you look? Because we have a change in leadership every 2 years in this country.
Yeah, and we're used to having that, and the markets are used to seeing that, and I guess you could say, well, it depends which way the powers are shifting, right? And I mean, traditionally, you're going to think of a Republican leadership as a more pro-business friendly, okay? And you're going to think of a Democratic as probably a little bit more on the regulatory side, and maybe wanting to raise taxes more or regulations, right? And taxes can come in as fees and tariffs and things like that. So, yeah, there is, it depends on which way we think it's going to shift, I guess, Peter, probably to give you a general answer there.
Well, retirement can be 30 years or more, so
Yeah.
elections over 30 years need to be thought about. And I know, Chris, I'm not sure the next 10, 15, 20 years I feel like are going to be as generous in the markets as the last 10, 15, 20 years have been. But who knows?
Yeah.
Does the direction of the market impact my method and timing for claiming my Social Security benefits?
Yeah, it certainly does. We work with a lot of folks that are drawn out of an income portfolio we created, and then if something happens in that income portfolio where the market tanks, something interest rate spike, whatever, then we may come back and say, okay, hey, let's pick up Social Security a year earlier than we had thought because of these factors. Or, hey, everything's going fine, your income's being met, you're doing good. We can wait on take Social Security until later, and you're going to get an increase in your payment by waiting later as well. Yep. And again, that depends on the individual case we're dealing with. Not everybody that's listening to the show that doesn't apply to.
For the sake of time, I'm going to combine these next two. I feel they're related. Number 8, how can I ensure my money lasts through a potentially long retirement? Hopefully, long retirement, right? And number 9, should I consider annuities or other guaranteed income products?
Yeah, and that's good that you tied those two together. That kind of hand in hand questions there. One feeds the other. Is that whether people like annuities or not, nobody mails their Social Security check back to the government and says, "I don't like annuities, don't pay me," or their pension payments. Okay, so for those of you that don't have pensions, there are many different types of insurance companies that offer some very solid income type products. Some of them have zero market risk associated with them. That would be the fixed annuity, the fixed index annuity. There is the variable annuity that still allows you to play directly inside the stock market, and you might have some guarantees on the income side. Those typically have a tendency to be a little bit more expensive, so we shy away from them. But yeah, absolutely. Why wouldn't you want to hedge the number one risk of that all retirees face is running out of money in retirement, or I would say running out of income is even worse.
Yeah. Well, number 10, and I know in the midst of market volatility, maybe our highest priority could potentially shift focus from this important question. But I think proactive planners, savers, and investors are still asking, is my current retirement plan accounting for the rising cost of healthcare and the potential risk of long-term care?
Yes, and it's an area I think everybody listening to the show here would agree that most of people do not even address. They hope it won't happen to them, and I can say that with a father-in-law in a nursing home, a mom and dad at 92 and 87 with caregivers helping to take care of them. It is reality, and people miss a 10,000, they insure their house that has a 1 in 1,200 chance of catching on fire, but they don't insure everything they've ever accumulated in their life that could cost them $10,000 a month, So I just think there are a lot of good products and services out there that you can look at to hedge that risk. I mean, why would you risk $120,000 a year when for $5,000 a year you can remove it completely and probably have some sort of death benefit and all of that if you never went into the nursing home? So, yep.
Well, there's a time and place to take risk. There's the potential for growth above the cost of inflation, but there are also strategies to help protect and hedge against the downside. A sound approach to volatility, ladies and gentlemen. Nobody likes to see the market lose value. We only want to take risks that are necessary and that pay off with potential rewards. But we also see from time to time the market behaving like it is, more unpredictably, more volatility, and we still need to continue a sound investment approach toward our long-term financial goals. That's why you need to stick to a game plan for retirement. And Chris McIntire, the team from McIntire Retirement Services, that is exactly what they offer to do for you, help you design or review and evaluate, continue to monitor and implement your game plan for retirement. Pick up the phone, give them a call, 419-332-0532, 419 419-332-0532, 419-332-0532, or go online, McIntyre-retirementservices.com. Get the plan in your hands that will help you learn specifically how to retire with confidence, how to pay less in taxes, how to maximize or optimize your money, your investments, your game plan for retirement. 419-332-0532. Chris, always a pleasure speaking with you. Thank you for addressing our current conditions and the market volatility that we are seeing.
Yep, absolutely. Hang in there, everybody. Brighter days ahead. And thanks for listening to the show, and God bless America.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Investment in notes involves risks not associated with investment in ordinary debt securities. The securities are not bank deposits and are not insured by the FDIC or any other government agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and there may be little or no secondary market for these securities, and secondary trading may be limited. Accordingly, you should be willing to hold your note security to maturity. These securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.